Okay, welcome back. Today we're going to be covering what's going on with the whole student loan situation. So, I've received a number of calls over the past couple of weeks of people just asking me what is happening, what is going on, what should I do? And so I put together a quick presentation to kind of help people figure out what is going on and what potential options are and what their next moves should be based on their particular financial situation. So, let's go ahead and get into it. Okay, so given all of the confusion, I did want to put a slide in the front saying exactly what is or what is not happening. Student loans, federal student loans, have been in what's known as an interest-free forbearance since March of 2020, around the beginning of the pandemic. President Biden put in an intention when he came into office and relieved President Trump that he would forgive all federal student loan borrowers up to $20,000 or $10,000 or whatever it was for people's particular financial situation. Counterparties sued the government. Think private student loan holders who would stand to lose in that situation, or individual borrowers who may not have been able to benefit from the policy or may have been hurt from the forgiveness or something like that. So the situation went to the circuit courts when the federal government was sued. Then it went up to the Supreme Court, and the Supreme Court struck down the policy 6-3. And as a part of the debt ceiling negotiations that took place over this summer in order to fund the government through this year and through next year, one of the provisions that made it into the bill that got passed was that Biden had to end the current freeze on federal student loans. Right. Up to this point, every 6 months or so, he would have to use one of the pandemic era policies in order to extend the freeze on interest and on payments. But the provision in the bill said that he could no longer do that after the end of August. So there's two things going on here. One is that the Supreme Court ruled that the federal student loans could not be forgiven. That decision came down in June. The second is that payments have to restart because of a provision that was in the bill that was used to fund the government over this summer. So that means that interest will start accruing very soon, starting in the beginning of September, and the loans are not going to be forgiven. The balances are not going to be reduced. So given all of that, we move into our potential strategies moving forward. Okay, so what do you do now? Debt's not going away, and you have to start making payments again. So the first thing that I would do is I would figure out who your student loan servicer is. So it's quite possible that because the debt has been frozen for 3 years, if you've come out of school within the last year, 2 years, 3 years, you may have never actually made a payment on your student loans yet. So it's paramount that you figure out who your actual student loan servicer is. You think of the converse situation where maybe you were paying on your loans prior to the pandemic, but it's been 3 years, a lot's changed. Even if you did know who your student loan servicer was before the pandemic started, it's quite possible that provider is not the servicer of your student loans now. You see, the government owns the student loan assets, but they don't actually manage the student loans themselves. They have contracts with these third-party companies that manage the student loans for the government. And so the people that we directly interface with are student loan servicers that are hired contractually by the government to manage the student loan portfolio. Over the pandemic, the contracts were redone. And so some of those servicers have actually changed. And so there are millions of people who were already paying on their student loans at the beginning of the pandemic or before the pandemic started, whose student loan servicers have changed since the freeze went into effect in 2020. I am one such person, right? I used to have my student loans with Great Lakes. And now my student loans are with Nelnet, right? It changed during the pandemic, during the freeze. So even if you knew who your student loan servicer was, I would still encourage you to go to figure out who your new servicer is, or if your servicer has changed. The way that you can figure that out is I recently had gotten an email from the Department of Education. It's down there at the bottom of the screen. Go to your Gmail account or whoever you have your email provider set up as, and just type in student loans and then try to filter to look for emails that have come in the last week. I received this email on August 29th, and these emails will always come directly from the U.S. Department of Education. You can see that the handle is no reply at studentaid.gov. You want to make sure that the emails that you're getting are actually from the Department of Education and not from some scammer or something like that. So once you click on that email, once you find it in your inbox, if they've sent it to you, which they should have by now, that email is almost a week old, it will tell you who your current student loan servicer is. And if you click on the link in the email and you sign up on the new student loan servicer website, then it will take you into your loans. You'll be able to see your balances. You'll be able to see your interest rates, and you'll be able to see your projected monthly payment. Okay. So once you do that, from that point on, right, you look at that monthly payment number and you say, can I or can't I afford this, right? And so then once you have all those numbers and you know who your student loan servicer is, then we can move to the next step. The last thing I'll say on this slide is that the following options are listed in a particular order. The order that they're listed in is the order of consideration, meaning that the thing at the top is the first thing you should consider, and the thing at the bottom is the last thing you should consider. So the way you want to go about this is, once you find an option in the potential strategies listed 1 through 6, you want to pick the highest number that fulfills all of your needs and then go and implement that plan. Okay, so step number 1 is, do you have room in the budget to afford this expense? So some people may have room, some people may not. I would separate this particular strategy into one of 3 groups, right? Group number 1 is excess cash flow. So that means that you have extra money that you've been using to pay down debt, or that you've been putting aside in cash as cash savings. Unfortunately, right, with student loans being turned back on and you're now having to make monthly payments, some of that money is going to have to be diverted from your savings or from your debt pay down in order to pay on your student loans, if you can afford to do so. If you can't afford to do so, then we move to group number 2, which is the excess spending group. So it's quite possible that over the pandemic, it's really easy to feel like your student loans really don't exist, right? It's somewhat of a philosophical question that if you have debt and it's not accruing interest and you don't have to make a payment on it, does the debt even exist? I'm not going to get into the philosophical debate at this point, but what is clear is that if you don't have to make a payment, out of sight, out of mind. So you have that extra cash flow coming in. And so maybe that extra money during the pandemic and afterwards went to lifestyle. So maybe you go out to dinner more, maybe you travel more or whatever. If you have increased your lifestyle in a way that is reversible, like going out to restaurants more often or something like that, unfortunately, what that would mean is that you may have to cut back in some of those areas in order to be able to pay back on your student loans, at least for the time being. And then if you're not in that situation where your increase in lifestyle is temporary or just excess spending that can be reversed, then you fall into group number 3, which is lifestyle creep. Your solutions going forward are going to be trying to get your payment reduced in some way so that you can afford it, in addition to those more permanent lifestyle adjustments. So if you find yourself in this situation where you have more permanent lifestyle increases that would prevent you from making payments on your student loans, then you want to move to option 2. Okay, so option 2 to me would be what's known as extended repayment. So under an extended repayment plan, this is only for federal student loans. This is one of the provisions built into federal student loans that allows you to take your standard repayment term and move it from 10 years, which is the standard repayment term, and move it to 25 years, up to 25 years. There are 2 types of extended repayment, extended fixed and extended graduated. So extended fixed just means that they re-amortize such that instead of having the normal period payoff of 10 years, it's now 25. So now your balance is projected to go from wherever it currently is with the interest included and go to 0 at the end of 25 years instead of at the end of 10 years. So extended fixed just means that your monthly payment is fixed over that 25-year period. Extended graduated means that your monthly payment will increase once every 2 years. Your payment will gradually increase over time such that you're making larger payments at the end of your loan than at the beginning. And so because you're paying most of the debt back at the end of the loan instead of at the beginning, it makes your monthly payment really small at the beginning of the loan, which is what you need right now if you're considering reducing the amount. I still have student loans, and when I first got my student loans, my balance was over 30,000. So I was able to sign up for extended repayment. Right now I'm on extended graduated. Now that doesn't necessarily mean that I am going to allow it to take 25 years to pay off. I have no intention on allowing it to take 25 years to pay off. But if I set up my term in such a way that I have 25 years to pay it off instead of 10, then my monthly payment goes down by a lot. And that will give me more options for what to do with that cash flow, whether I want to use it to pay down other sources of debt or double down on the student loans or put the money into something else that's more immediate and important. The other thing I'll say is extended repayment is pretty easy to sign up for. The only thing you have to do to sign up for extended repayment is to call your student loan servicer, the party that you identified on the previous page, and then simply ask to go on extended repayment. The only restriction is for extended repayment is that your original loan balance has to have been greater than or equal to $30,000. In my case, it was, but I know for a lot of people that isn't the case. So extended repayment can be a really good, really fast option for people who have high loan balances, you don't have to put in any special applications for anything else. You don't have to get permission to do this, but it could be a nice, quick option for people who have high loan balances. If you don't have high loan balances, then talk about that in the third potential strategy. Okay, so here we are. Third potential strategy. So if you don't have room in your budget to make room for the payment, and maybe your loan balance is too small to consider for extended repayment, where your plan goes from 10 years to 25 years, you have option number 3. Option number 3 is you would use one of the government I.D.Rs. So the government has a number of I.D.R plans. I.D.R stands for income driven repayment. So under a normal payment plan, the amount of money that you would have to pay is based on what's known as an amortization schedule. So an amortization schedule is your monthly payment will be calculated based on ever the payment would have to be such that with principal and interest included, your balance would drop down to 0 at the end of the term, right? So if you're on a 10-year repayment with a 5% interest rate, your monthly payment will be whatever it has to be such that you can pay back your full principal amount plus the interest in that 10 years such that your balance is 0 at the end of the 10 years. That's how a normal payment plan will work. Under an income-driven repayment plan, your payment is calculated based off of your income instead of an amortization schedule. The result of this is that your payment is connected by your ability to pay. So if your income is lower, then your monthly payment could be lower. It's likely to be lower. So currently, the government has 4 I.D.R plans. I have the 4 listed there: ICR, I.B.R, Pay, and Repay. It's not really important what the individual differences are between all of the different plans, but I put the commonalities between them in some of the large bullets below. So the payments are made as a percent of your discretionary income. This is typically between 10 and 20%. Discretionary income is calculated based off of some government numbers, right? Discretionary income is not necessarily discretionary to you. It's what the government thinks should be discretionary. The second is that all the I.D.Rs provide some built-in form of student loan forgiveness at the 10 to 25 year mark of making payments. I also want to start to mention about the new government program, which seems to be much better than the existing government programs, called S.A.V.E. S.A.V.E is meant to replace the 4th government I.D.R plan called Repay. And based on the provisions that I've read, it seems to be a lot better than Repay or any of the other I.D.R plans. So I'll list out some more information on the S.A.V.E plan on the next page. But as far as the elevator pitch goes, if your income is low enough, then your monthly payment would be 0. And I list out some numbers for what it would take for your monthly payment to be 0, right? So for a single person, family 1, if you have an income of $30,000 or lower, that's approximately $15. Then your monthly payment would be 0 under this new S.A.V.E plan. For a family of 4, that monthly payment of 0 number would be $60,000 a year. So given the fact that there are 4 different I.D.R plans, including S.A.V.E, you may be wondering if S.A.V.E is the best I.D.R plan for you. I'm pretty sure that it probably is if you're not considering extended repayment because your original original loan balance is smaller than 30,000, but I will put a link in the description that goes directly back to studentaid.gov, which will set up basically a calculator, which will calculate your monthly payments based on all the different I.D.Rs, and it will tell you which one is the best one for you. And then once you figure out which one is the best one for you, you can follow the link in the federal student loan calculator, and then it will take you to an application so that you can apply for the one that is best for you based on the numbers you show. But I did want to give you a preview of what those numbers would look like under the new S.A.V.E plan. Okay, so here's the numbers for the new S.A.V.E plan, and then I'll also list out some of the best provisions that I've seen from this new I.D.R called S.A.V.E. I do want to make clear that these provisions are not expected to go through until next summer, usually July of 2024, but you can still apply for the S.A.V.E plan now. They have like a beta version available on the federal ed website, so you can go ahead and enroll and you'll be under the I.D.R plan. And then once the updates come down next summer, you'll automatically be enrolled into those updates as well, but you'll already be on the I.D.R plan. I did want to point out some of the provisions that I thought were very good and make this plan different from the other I.D.R plans that the government already provides. Number one is that come summer of 2024, payments for student loans under the S.A.V.E plan will be capped to 5% of discretionary income. The second provision is this whole interesting thing about forgiveness. Once again, for people who have original loan balances of $12,000 or lower, they only have to make 120 payments on their student loans under the S.A.V.E plan, and then they are expected to receive full forgiveness for the remaining amount. If you have undergraduate student loans, if you have loan balances above $12,000, then they add an additional 12 payments per $1,000. So let's say, for example, you had an original loan balance of, let's say, $13,000 instead of $12,000. Then you would not receive payment in 10 years. You would receive payment in 11 years for your original loan balance of $13,000. If you had an original loan balance of, let's say, $15,000, right, that'd be an extra 3 years worth of payments you'd have to make. And so that would take your loan forgiveness number from 10 years to 13. Another provision that I really like that is usually not included for I.D.R plans, which is that unpaid interest is not going to be added to your principal balance at the end of the month. So typically with I.D.R plans, unpaid interest is added to the balance at the end of the month. What this means is that if you're on an I.D.R plan, it is quite possible that you are making monthly payments month in and month out, but your balance may actually be rising, because if your monthly payment, which is calculated based on your ability to pay, is not based on the amortization, it's possible that at the end of the month after you've made a payment, that your balance, the interest that has accrued over that month, has not been fully paid, which means that that extra interest is going to go to the principal balance, which means that your loan balance is going to be higher at the end of that month than it was at the beginning of that month. And if you keep doing that every month, then your loan balance is going to be higher at the end of that year than it was at the beginning of that year. And so I know a lot of people have been caught by that, because they're like, I'm on a government I.D.R plan and I'm making payments, but I'm seeing my balances go up. And that's because you're not fully paying on the interest that has accrued over that period. So your balances rise. The S.A.V.E plan is supposed to rectify that by basically saying, if you make a payment, any extra interest that is accrued that is beyond your monthly payment is going to get removed. It's not going to get added to the principal balance. So you're never going to see your balances rise if you're under S.A.V.E. That is not true for other I.D.R plans. If you do decide to enroll in S.A.V.E and these numbers look appealing or acceptable to you, you can put in a request of the application on the studentaid.gov website. I will put a link for that in the description, and you can follow the link from the calculator that I mentioned earlier that will take you directly there. I do understand that everybody is in a unique financial situation. I think the S.A.V.E program will probably be good for the majority of people. So if you think you've found your option and this sounds good and appealing to you, then I would consider following that link and then going ahead and putting in this S.A.V.E application for the I.D.R plan. The last thing I'll mention is I was also, with regards to the S.A.V.E plan, I was also made aware of an interesting provision that I recently recently verified by reading the Department of Education's website, is that they plan to do full forgiveness for any federal student loan holder after 20 years for undergraduate loans. So you have to make 20 years worth of payments, or 25 years for any graduate student loan holder. So if you enroll in S.A.V.E, in the S.A.V.E I.D.R plan, and you have an undergraduate loan, regardless of what your balance is, the plan is to forgive that balance after 20 years. If you have a federal graduate loan, the plan is to forgive that balance after 25. Now, again, this only applies to people with high balances. If you have a balance that is low, like 12,000, your expected forgiveness timeline is 10 years, right? For every 1 year after 12,000, you add an extra 12 payments, an extra year's worth of payments. And that's currently how they're deciding to do the student loan forgiveness thing going forward. The other thing I'll say about that is you want to be careful about the government's promises with regards to student loans as far as the forgiveness is concerned, because we literally just seen what just happened, right? Biden made a promise that he was going to forgive student loans, and he can't keep that promise because the Supreme Court decided that what he was trying to do was not constitutional. It was outside of given executive authority. Now, that was a campaign promise from Biden to do that, but he may not have ever had the actual ability to do that. So when the government makes promises that they're going to forgive your loans, you always want to take it with a grain of salt. It doesn't necessarily mean that it won't happen. It means that you probably shouldn't build it into your long-term financial strategy that it will happen, because there is a probability that it won't happen, just like what we've just seen. So I think most people have probably found their solution. If these numbers look appealing to you, go ahead and apply for the S.A.V.E plan using the link that I provided in the description to the calculator. Put in your numbers in the calculator, follow it all the way through like I put on the previous page. And then once you got your numbers for the S.A.V.E plan, go ahead and apply and put in the application. But I am aware that everybody's financial situation is different, and it is quite possible that the S.A.V.E plan may not be a good alternative for you because your income may be too high, right? You might be in one of those red boxes or higher, and you still don't necessarily have the cash flow in order to pay for your student loans. I have something for you too if you happen to find yourself in this situation. So we do have a couple of more options to go through. My intention when I put this together is that there would be a solution for literally everyone who would be in this situation where they don't have the cash flow to cover their student loans. I think most people will probably be covered under S.A.V.E and extended repay. But if these two options don't suit you, let's go on to option number 4. Okay, so option number 4. If your income is potentially too high to qualify for one of the I.D.R plans, you can consider the government PSLF program. PSLF is Public Service Student Loan Forgiveness. So basically what it is if you make 120 qualifying payments while you work for a qualified employer, then the government will forgive your remaining balances regardless of what the amount is my understanding. So the problems kind of with this one is that you have to work for a qualified employer, and there's no database of which employers are qualified employers. You have to send in a form to the Department of Education asking if your employer is a qualified employer. Typically, qualified employers are if you work for a government organization, like if you work for a local government, the state government, or if you work for the federal government, then you're typically good in that regard. But some other nonprofit organizations also would fall under the PSLF umbrella. You could ask your HR department if they are aware, if they're certain that your organization is covered under PSLF. That would be a good option if you already happen to work for a qualified employer. I will put a link in the description if you are interested in trying to figure out whether or not your employer is a qualified employer. I'll put in a link to the application and to some resources that can help you figure out whether or not your employer is a qualified employer under PSLF. But if you find out that you don't work for one of the governments or nonprofit organizations, so you know that you would not qualify under PSLF, and so if you fall into that situation and your income is too high to qualify for an I.D.R plan, then I would consider continuing through this presentation. So let's proceed to option number 5. So option number 5 would be deferment or forbearance, right? So they're two things that are very similar. So we're going to cover forbearance first. And so in the case of a forbearance, you don't have to make payments on your loans during the period of the forbearance. Typical forbearance typically lasts about a year, and there's typically no limits on the number of forbearances that a person can request. However, the interest is not frozen during a normal forbearance period. So even though you don't have to make payments, your loan balance is still growing. And so once the forbearance ends, you may have higher payments than when you started. And so this is why they don't limit the number of possible forbearances, because it just allows them to make more money off you. And I don't necessarily agree with the practice of forbearance, but it is an option for people who may be in a situation where they see the tightness of their financial situation as something that is temporary, something that is a hill that they're going to kind of get over pretty soon. And so this could be an option, because in order to get a forbearance, the only thing you have to do is call your student loan servicer that we talked about in one of the earlier slides and ask for forbearance. And typically they'll grant it. I haven't seen anybody get denied a forbearance. So a deferment is basically a better version of a forbearance. You still don't have to make payments on your loan. Typically the deferment period lasts about a year, but the difference between a forbearance and a deferment is that you do not have to make payment on your loans and the interest is frozen. So kind of like the situation where we've been in the last 3 years, you can basically get an extension of that particular situation. The problem is that you have to apply for a deferment. You don't have to apply for forbearance. All you have to do is call and ask for one. Before a deferment, those are typically not granted, and you typically have to be under some significant hardship, dealing with some sort of illness or an extended period of unemployment or underemployment or some other special circumstances, like, you're in the service and you're getting deployed or something like that. Typically, deferments are only granted under special circumstances, which is why deferments and forbearance are so far down this list. It's so hard to get deferments, and forbearances are so bad that you really should only use them in case of emergencies. But if you find yourself this far into the presentation, then what that means is you can't make room in your budget. Your loan balance is too low to be considered for extended repayment. Your income is too high to consider an I.D.R. You don't work for a qualified employer, so you don't qualify for PSLF. So then that leaves you with possibly number 5, which is deferment and forbearance. So these, I just want to make it clear that these are potentially temporary options. Neither of these are permanent. They only last a year. You can only get up to 3 deferments, even if you do qualify for the better deferment. And forbearance is just dig you deeper into the hole, but you hope that your financial situation improves in that year such that you can handle what your new circumstances are on the end. But again, they are both temporary solutions to a more permanent problem. So if you are seeking more permanent solutions and you think your financial situation is going to be, your financial hardship is going to be a little bit more prolonged, then I would consider number 6. If you think that maybe in the next year or the next 2 years, you don't think that your financial situation is going to improve very much, it'd be worthwhile to at least consider number 6, which is the worst option on this list, which is refinancing, right? So refinancing just means that you are taking your public student loan that is currently owned by the federal government and you're replacing it with a private student loan that is now owned by a private student loan company or by a bank. The downsides of this is that you have basically replaced your federal student loan with a private student loan. The act of doing that means that you lose a lot of the provisions that we talked about earlier. No more PSLF, no more access to I.D.R plans, no more access to extended repayment, no more access to deferments and forbearances. You have to set up special circumstances with your private borrower in order to get really any leeway on your payment amount or on your term or your interest rate or anything like that. It basically just becomes another loan at that point, just like any other loan. But under certain circumstances, refinancing may allow you to get a lower interest rate or better terms. But the reason that refinancing is so low on this list at number 6 as the very last thing that you should consider is because of the economic conditions that we currently find ourselves in. The Federal Reserve has been raising interest rates for the past 18 months or so. And because interest rates are at an all-time high, anytime you try to refinance debt, it's likely going to be at a higher interest rate than the rate you already have. So the probability that you'll get better terms on your loan by refinancing it is very low. In addition to losing all of the federal protections that are afforded to people who own federal student loans. So I wouldn't really recommend this unless you really, really have to. If you do find yourself in that situation, it may be worthwhile to at least consider what the rate and the terms would be if you were to do a private refinance. But it's likely not going to be good. It may be something worth checking out if you find yourself in that particular situation, which is a very unique situation to be in. The other thing I'll say about private student loans and refinancing is do not be fooled by introductory APR. Sometimes they'll give you like a flex APR that's way lower than market rate, but they plan on raising it very high in the near future after you've been in repayment for like a year or two. And so you definitely want to look at the totality of the loan when you decide whether or not the loan is going to be good for you. Don't look at the interest rate just at this moment, but look at the interest rates that you're going to have to pay in the long term, and always try to look for a fixed rate because those are the loans that are the most predictable. The other thing I'll do is say, watch out for scammers. The federal government or anyone that's going to help you with your student loans is never going to ask you for money. So if someone contacts you and says, well, I can forgive your student loans or something for, if you make a payment of $100 today, don't believe any of that. Those are all scams. Okay, so thanks for sticking around. If you made it all the way through the presentation and maybe you were just curious about seeing what all the potential options are. So here is a summary of all the potential options you have. So as I said at the beginning of the presentation, you want to consider these options in the order that they appear in this presentation. The best options are always at the top and the not so great options are closer to the bottom. So the best option that anyone could possibly have, right, is to establish whether or not they have room in the budget to make room for this additional expense. Even though that may not be very favorable, in theory, it will be a short-term condition as you work to improve your finances and create extra cash flow, which will allow you to take care of these loans much faster and in a way that does not impact your long-term financial health. If you can't do that, then you should consider extended repayment, which is simply making a call to your student loan servicer saying that you want to extend your default federal student loan term from 10 years to 25. The act of doing that will lower your payment considerably. I can speak to that because I'm on extended repayment now, and that solution seems to be working for me. There's two types of extended repayment: fixed extended, which gives you a fixed payment for 25 years, and extended graduated, which readjusts your payment every 2 years for the full length of the loan, so that you are paying more at the end of the loan and less at the beginning. Whereas with fixed payment, your payments are fixed across the full 25-year span, but they don't go up and down. Option number 3 is if your income is low enough, then you want to consider an I.D.R plan, particularly the government's new plan called S.A.V.E, which will cap your payments at 5% of your discretionary income starting in the summer of 2024. It also does a lot better than other potential I.D.R plans because it removes interest accrued beyond your monthly payment, which other I.D.R plans don't do. Under a normal I.D.R plan, you would make a payment, and if you had leftover interest that was not paid, that extra interest would go to your principal. And so you could actually see your balances rise under an I.D.R plan. An I.D.R plan was never meant to be a permanent thing. It was just meant to help you kind of get by through a rough situation. But it can quickly backfire because you've been making payments for years and years and years and years, but you're seeing your balances rise because you're not knocking that interest out. But the S.A.V.E plan is much better because it eliminates accruals of interest. It caps your monthly payments at a low amount, and potentially student loan forgiveness at 10 years for anybody that had an original balance of $12,000 or less. For anybody that has balances greater than $12,000, an additional $1,000. For every additional $1,000 borrowed, that would be an extra 1 year's worth of repayment, with a maximum cap of 20 years for an undergraduate loan and a maximum cap of 25 years for a graduate loan. If your income is too high to consider an I.D.R, but you maybe work for a government organization or a nonprofit, consider public service loan forgiveness to see if you qualify for that, which would require 120 payments. If you know you don't work for a qualified employer, you're in a tight financial situation, maybe consider deferment or forbearance. If your financial situation is really tight and you perceive that your financial situation is temporary, because these are purely temporary solutions, they're not meant to be permanent solutions to this problem. And then lastly, if maybe you've exhausted your number of forbearances and you don't qualify for deferment, consider refinancing. Typically, refinancing is a better option than it is currently, but because of the unique economic conditions that we're in, refinancing is probably the worst option, and it's almost guaranteed to not get you a better rate. Okay, guys, thanks for sticking around. If you're still here, hopefully you found the information that you needed in this video. Feel free to use any of the links in the description to go through anything that I've mentioned in the video. And if you made it all the way this far, don't forget to like, comment, and subscribe. Let me know if there's anything else that maybe you would have said, or any questions you may have about the student loan process or financing or applying for the S.A.V.E plan. Just let me know, and have a good day.